Hi, and welcome to the week ahead. I am Tony Nash, and this week we're joined by Dr. Daniel Lacalle, or Daniel Lacalle. Daniel is a chief economist. He is a fund manager. He's an author. He's a professor. Kind of everything under the sun. Daniel does. Daniel, thank you so much for joining us today. I know you have a very busy schedule, and I appreciate you taking the time to join us. We're also joined by Tracy Shuchart. Tracy is the president at Hightower Resources, a brand new firm. So pop over and see Tracy's new firm and subscribe. We're also joined by Sam Rines of Corbu. Thanks all of you guys for taking the time out of today. Before we get started, I'm going to take 30 seconds on CI Futures, our core subscription product. CI Futures is a machine learning platform where we forecast market and economic variables. We forecast currencies, commodities, equity indices. Every week, markets close, we automatically download that data, have trillions of calculations, have new forecasts up for you Monday morning. We show you our error. You understand the risk associated with using our data. I don't know of anybody else in the market who shows you their forecast error. We also forecast about 2,000 economic variables for the top 50 economies globally. And that is reforecast every month. There are a few key themes we're going to look at today. First is liquidity drain and quantitative tightening, or QT. Daniel will lead on that, and I think everyone will have a little bit to join in on that. We'll then look at copper gap, meaning we don't really have enough copper over the next, say, 10 years to fill the needs of EVs and other things. So Tracy will dig into that a little bit. We've had some earnings reports for retail over the past couple of weeks, and Sam had a fantastic newsletter on that this week. So we'll dig into that as well. Then we'll look at what we expect for the week ahead. So Daniel, thanks again for joining us. It's fantastic. You've spoken to our group, I think about a year ago or so, and it was amazing. So you tweeted out this item on screen right now about the liquidity drain. You sent that out earlier this week, and it really got me thinking about the complexities of draining liquidity from global markets, especially the US, since I guess global markets are hypersensitive to draining in the US. Of course, rate hikes get a lot of headlines, but you mentioned QT, so it's a bit more complicated. Obviously, QT peaked in April of this year. There's a chart on the screen right now at just under $9 trillion US dollars. And the Fed's put about $200 billion back from their balance sheet, back into markets from their balance sheet, which isn't nothing, but it's really not much compared to the total. So I guess my question is, where do we go from here? Most of the Fed's balance sheet is in Treasuries, as we're showing on the screen right now, followed by mortgage-backed securities. So what does this say about the path ahead? What do you expect? How quickly do you expect? Does it matter that much?
Mm-hmm. Thank you very much, Tony. I think that it's very important for the following reason. When people talk about liquidity, they tend to think of liquidity as something static, as something that is simply there. And when central banks inject liquidity, it's an added. And when they take liquidity away from the system, that simply balances the whole thing. And it doesn't work that way. Capital is either created or destroyed. Capital is not static. So when quantitative easing happens, what basically happens is the equivalent of a tsunami. No? You basically add into the balance sheet of central banks, trillion, whatever it is, of assets, though by taking those assets away from the market, you generate an increased leverage that makes every unit of money that is created from the balance sheet of the central bank basically multiply by 5, 6, we don't know how many times. And it also depends on the transmission mechanism of monetary policy, which is at the end of the day what the reason why central banks do QE is precisely to free up the balance sheet of commercial banks so that they can lend more.
Let me stop you there, just to dig into, so people understand what you're talking about. When you talk about transmission mechanism and the Fed holds mortgage-backed securities, the transmission mechanism would be through mortgages taken out by people because mortgages are cheaper because the Fed is buying MBS. Is that fair to say?
Not cheaper. Not They don't necessarily have to be cheaper. They have to be more abundant.
That's good. Yep,
Ultimately,
that's fair. That's fair. Yep.
yeah.
Okay.
Ultimately, this is why when people talk so much about rate hikes or rate cuts are not that important. But liquidity injections and liquidity draining are incredibly important for markets, because rate hikes or rate cuts do not generate multiple expansion. Yet liquidity injections do create multiple expansion, and liquidity draining is much more severe than the impact of the rate hike.
Okay, so when you say multiple expansion, you're talking in the equity markets?
In equity markets or in the valuation of bonds price,
Okay.
that means lower bond yields, or in the valuation of private equity. We saw, for example, in the period of quantitative easing, how the multiples of private equity transactions went from 10 times EV to EBITDA to 15 times easily without any problem. No? So
Okay.
what quantitative tightening does is much worse than what quantitative easing does, because the market can absorb an increase of liquidity through all these multiple assets. However, when quantitative tightening happens, the process is the reverse. Is that the first thing that happens, obviously, is that the Treasury, the allegedly lowest risk asset, becomes more cheap, i.e. the bond yield goes up, the price goes down, the bond yield goes up, and in turn it creates the same multiplier effect, but a larger dividing effect on the way out.
So the
So
divisor is greater than the multiplier.
the divisor is greater, and I'll tell you why. In the process of capital creation, there is always misinformation that leads to multiple expansion. Okay, so one unit of capital adds to more units of capital plus a certain excess valuation, etc. Now, from that point, if you reduce one unit of the balance sheet of the central bank, the impact down is much larger. So where it goes to, this is the problem that we as investors have find it very difficult to analyze, is where is the multiple at which equities, bonds, certain assets are going to stop, because it is very likely to be below the level where they started. Okay. And that is, and the challenge of quantitative tightening is even worse when the process of quantitative easing has been prolonged, not just in period of compression of economic activity or recessions, but also in the periods of growth. Okay. Because the level of risk that investors take becomes not just larger, but exponential.
Under that's QE why versus QT.
Under QE. Okay. So under QT, under QE, you get Bitcoin going from 20 to 60. Under QT, you get Bitcoin going from 60 to maybe 0. I don't know. Huh?
But the comments are going to be full of angry Bitcoin people. So
I don't know, okay. No, but I just want people to understand that just like on the way up in a roller coaster, you go slowly and it seems that everything is going relatively smoothly. When you start to go down, you go down really fast, and it's truly scary.
Okay, so let me ask you this, because when you talk about multiple expansion, I'm sure we're going to get some comments back about tech firms, because we've seen tech firms' multiple expansion decline pretty dramatically in the past, say, 6 months, certainly past year for companies like Meta. So although we've only seen $200 billion on quantitative tightening, how does that reconcile with your statement about interest rates not necessarily impacting valuations?
No, interest rates impact valuations, but not as aggressively as quantitative tightening. You know?
Okay.
They do, particularly in tech, for a very simple reason. I think that all of us can understand that a technology company is, in the process of money creation. A technology company is one of the first recipients of newly created money, because it absorbs capital quicker,
Yeah.
and it obviously benefits enormously from low interest rates, obviously. No? But the process of multiple expansion tends to happen in the early stages of those companies. Okay, now in the process of multiple compression is much more vicious,
Mm.
because I would be genuinely interested to have a discussion with I don't know, with people that invest in non-profitable tech, but I would really like to understand how they get to the current levels of valuation comfortably. No, so the biggest problem I see of quantitative tightening is the same problem I see that of the hidden risks of quantitative easing, is that central banks cannot discern which part of the wealth effect comes from the improvement in the real economy or simply from bubbles. And the creation of bubbles, obviously, if we can imagine that something is a bubble, but we don't really know until it bursts. No, so it's going to be very problematic for a central bank to achieve almost one thing and the opposite, which is what they're trying to do. What they're trying to do is to say, okay, we're going to reduce the balance sheet. Hey, we're going to reduce the balance sheet by 95 billion a month, and think that that will have no impact on the bond market, on the equity market, and on the housing market. The housing market is already showing.
Yeah, I don't necessarily think they're saying that we'll have no impact on that stuff. Sam, is that from your point of view, or is that their expectation that QT would have no impact on asset prices?
I wouldn't say it's their expectation that it wouldn't have an impact on asset prices. I think they understand that there's an impact on asset prices from just the narrative of tightening generally. But to the point, I think it is very difficult to parse what portion of their tightening is doing what, particularly for them. You look at some of the research on coming out of the Fed on what QT is expected to do and what QT does, and you come out of it thinking they have no idea. I think that they would probably say that quietly behind closed doors without microphones. But to the point, I would agree that there is an effect, and that the Fed likes to say set it and forget it, because they don't really understand what the actual impact is on either the real economy or the financial economy. And you come up with R star star to, which is, some stupid concept that they decided to come up with to rationalize some of their ideas. But I would say, no, that makes perfect sense, that they really don't understand exactly how much it is, which is why they say, we're just going to set it, forget it, and we're not really going to talk about it. Because if you listen to the Fed, their concentration is on, call it, the path to the terminal rate and the length of holding the terminal rate there. And if you Google or try to find any sort of commentary about quantitative tightening within their speeches and their statements, it's actually pretty hard to find.
Yeah.
So
just to clarify one thing, in the messages from, for example, of the ECB and the Bank of Japan, less so of the Fed, and I would absolutely agree with that, because the Fed is not so worried because they know that they have the world reserve currency. But the ECB and the Bank of Japan certainly expect very little impact on asset prices. For example, the ECB are just saying right now that they're expecting to reduce the balance sheet in the next 2 years by almost €1 trillion without seeing spreads widening in the sovereign market. That is insane, to be fairly honest. But that's so that is what I'm trying to put together, is that a central bank that is unable to see that negative bond yields and that compressed spreads of sovereign nations relative to Germany is a bubble, is certainly not going to see the risk of tightening.
So
I mean, I would start with saying that if the ECB thinks they're going to take $1 trillion off the books in a couple of years, that's the first insane part of that statement.
good. Okay, so what I'm getting from this is taking liquidity out of markets can be really damaging, and the guys who are doing it don't really know the impact of their actions. Is that good top level summary?
Absolutely. That is it. That is the summary.
Okay, so would it then make, since they've only taken 200 billion off, I say only, but compared to 9 trillion, it's not much. Is it, since they're pulling the interest rate lever now at the Fed, and they're kind of tepidly moving forward on the balance sheet, do we expect them to finish the interest rate activities before they aggressively go after the balance sheet? Or are they just going to go march forward with everything?
No. I think that you will see, they want to see the impact of interest rates first before they make a drastic action on the balance sheet, particularly in the case of the Fed with mortgage-backed security and in the case securities, and in the case of the Bank of Japan with ETFs, because the Bank of Japan is going to kill the Nikkei if it starts to get rid of the ETFs, and certainly the Fed is going to kill the housing market with mortgage-backed securities unwinding.
Yep.
Yeah,
Okay.
and then it's kind of interesting because there's two dynamics that I think are intriguing here. One is that the Fed's balance sheet is getting longer in duration as interest rates rise because those mortgage backs are just blowing out to the right, because those aren't going, you're not going to have you're not going to have the roll down, and you're not going to have the prepays on those mortgages anytime soon. So, the Fed is putting themselves in a position where hitting those caps on mortgage backs is just simply not going to happen on a mechanical basis. And they're either going to have to sell, or they're going to have to say, we're not going to hit our cap on mortgage-backed securities for the next 20 years.
Yep.
Mm-hmm.
So they can just hold those to maturity, like they're doing with a lot of the Treasury debt.
Yeah, they're just letting them roll off, which means they're not going to have mortgage backs rolling off with a 6.5% refi rate.
No.
Yeah, I agree with that.
Wow, fantastic. So it's almost as if QT potentially is a non-issue for the longer duration debt. Is that? Are you saying they'll continue holding it, Sam? You're saying no. So what am I missing? So what I'm hearing is they may just hold the longer duration stuff. So if that's the case, is it kind of a non-issue if they just hold it?
It's not a non-issue. They will. They are in conversations all the time with the Bank of Japan to do this concept of yield curve management, which in a sense means playing with duration here and there on the asset base, but it doesn't work when the yield curve is flattening all over the place, and when you have a negative yield curve over in almost every part of the structure. But so the point is that by the time that markets realize the difficulty of unwinding the balance sheet the way that central banks have said, probably the impact on asset prices has already happened, because commercial banks need to, and margin calls, etc. Margin calls become more expensive. Commercial banks cannot lend with the same amount of leverage that they did before, etc., etc. Capital is already being destroyed as we speak.
Great.
And to that point, as soon as you had the Bank of England announce that they were going to have an outright sale of gilts, you saw what happened to their market. They broke themselves in 2 minutes. It was amazing.
Right. Okay, so that's what I'm looking for. So it's a little muddy. We're not exactly sure, right? And so QT is complicated. It's really complicated, and liquidity is dangerous. Like you say, Daniel, it's easy on the way up. It's really hard coming down from it, and that's where
Exactly.
economies
You
get
know,
wrecked. You know,
somebody, I think it was Jim Grant recently, who said how easy it is to become a heroin addict and how difficult it is to get out of it.
sure. Yeah, I mean, not
And
that I know, but I can see that.
we don't know it, obviously. I know none of us do. But it's very easy. It's a very visual way of understanding how you build risk in the system and how difficult it is to reduce that risk from the system.
Yeah, just stopping adding liquidity is a good first step. And then figuring out what to do after that is, I think they're right. A lot of people like to knock on the Fed, but doing one thing at a time is, I think, better than trying to, reconcile everything at once. So, okay, great. Since we're taking a little bit of longer term view on things with some of that mortgage-backed security debt, I just also was in a longer term mood this week and saw something that Tracy tweeted out about copper consumption and demand. This was looking at long-term demand, say by 2030, and there's a gap of what, 10 million tons. Is that right, Tracy?
8.1 million tons.
8.1 million tons. Okay.
8.1 million tons.
So now, when we look at copper prices right now, we've seen copper prices fall, and we don't really have an expectation of them rising. On the screen is our complete intelligence forecast of them rising, in the next few months. So why the mismatch, Tracy? What's going on there, and why aren't we seeing the impact on copper prices right now?
Well, I mean, if we look at base and industrial metals, really as a whole, except for, say, lithium, really we've seen a very large pullback in all of these prices in these specific metals that we are going to need for this green transition. Now, part of that is, I think part of that is, QT. We're just saying liquidity drained from the system, but I also think that we have overriding fears of a global recession. We also have seen, people are worried about Europe because with high natural gas prices, a lot of their smelting capacity went offline, and one would think that would be bullish metals, but it's scaring the market as far as global recession fears. And then, of course, you always have China, which is obviously a major buyer of industrial-based and industrial metals. They're a huge consumer as well as producer of, say, solar panels, wind turbines, and things of that nature. And so I think that's really the overriding fears. And, what I've been talking about, even for the last couple of years, that I think metals is really going to be more of a H2 2023 into 2024 story. I didn't really expect this year for that to be the real story. I thought that energy was still going to be the focus. And I think, even though we've seen prices come off in energy, I mean, energy prices are still very high. And I think energy prices, we're going to see a resurgence of, natural gas prices again in Europe as soon as, we kind of get past March, when, that storage is kind of gone, because we have to realize that, even though the storage is full this year, 50% of that did still come from piped in natural gas from Russia. And so, I think we'll set to see natural gas prices rise higher. Oil prices are still high, even at, $75, $80. It's still traditionally high. And so the input costs going into metals, as long as they're trying to bring it all together, the input costs going into metals, we're going to need a lot of fossil fuels. It's very expensive. We also have seen mining capex suffers from the same problem that oil does, is that over the last 7 years, we've seen huge declines. And then when we look at copper in particular, we really haven't had any new discoveries since 2015. So all of those are contributing factors, But again, I don't think that's really a story until last half of 2023 and 2024 going forward.
Okay, so to me, the copper price tells me, and tell me if I'm wrong here. Copper price tells me that markets don't believe China is going to open up fully anytime soon. And they don't believe China is going to stimulate anytime soon. Is that a fair assessment, or?
Yes, absolutely. I mean, I think we kind of saw metal prices were bouncing on some of the headlines back and forth, but really we haven't seen anything come to fruition, and I think most people are not looking until probably spring for them to open up. And I think, China really hasn't changed its stance, right? As far as, with their zero COVID policy, they're still on that. And so, I think markets are kind of, have been digesting that over the last couple of weeks or so. And that's also another contributor to seeing a pullback in some of these metals and in the energy sector.
Yeah, if you look at headlines over the past week, you definitely see a softer tone toward China. With Xi Jinping coming out in the APEC meeting, not the APEC meeting, the ASEAN meeting, and he's a real human being, all this stuff, and he's talking with Biden, and he's talking with European leaders and Southeast Asian leaders, and so I think there's been a softer tone toward China and this belief that good things can happen in the nearer term, but I don't think most investors will believe it until they see it, first of all, and I think places like Japan, Korea, Taiwan, US, other places, maybe not the Germans, are also a little bit worried about short-term sentiment in China. Things could turn pretty quickly. So, like you say, I think base metals prices are down on that. But over the long term, obviously, it doesn't seem like there's enough capacity right now. So anyway, we'll see. So thanks for bringing that up. Sorry, go ahead, Sam.
Yeah, I think there's just two things to add there. One, if you didn't have investment in base metals and energy at zero interest rates, you're not going to get it at 5. I mean, let's just be honest. I mean, that's point number one, is that this isn't a short-term thing. This is a much longer-term thing, and you need to have much higher prices for commodities broadly in order to incentivize any sort of investment, because they're, one, very capital intensive, and two, capital is very expensive right now. So I think that's also something to keep in mind over the medium term, is we're not solving this problem at 5.5%, interest rates here. That's clearly not going to happen. And, the other thing is, right, you haven't seen the Aussie dollar react in a positive way. So if the Aussie dollar isn't reacting, China's not reopening. It's just that simple.
Yep. That's a very point.
If I may, I would also like to point out that the bullish story for copper, lithium, cobalt is so evident from the energy transition and from the disparity between the available capacity and the demand. But when the gap is so wide between what would be the demand and the available supply, what tends to happen is that the market, rightly so, sees that it's such an impossibility that you don't even consider, at least as a net present value view, that bullish signal, as Tracy was mentioning, until 2023 or 2024, when it starts to manifest itself. Right now, it's so far between the reality of the available supply and the expectation of demand that it looks a little bit like what happened with solar in 2007, 2008. You just saw bankruptcy after bankruptcy because you didn't match the two. And on top of it, this is the first, Tracy, correct me if I see it, but this is the first year in which you had a massive bullish signal on prices in energy and in metals, yet you've seen no response from capping.
Exactly. Nobody's prepared. Nobody wants to really still spend that kind of money, particularly not the oil industry, when they're being demonized by everybody in the West in particular. So, you're not going to see nobody wants to invest in a project when they're saying we want to phase you out in 10 years.
Yeah, you bet.
What's really interesting, though, also is BHP bought a small mid-sized copper miner in Australia today, or this week, so I forget their name, but the miners are seeing opportunities, but they're just not seeing the demand there yet. So we'll see what happens there. So anyway, thanks guys for that. That's hugely valuable. Sam, you wrote on retail this week, and you have really brought out some interesting dynamics around pushing price versus volume within stores over the past several months. And your newsletter looked at Target, Walmart, Costco, Home Depot, earnings across retail sectors. So Costco and Home Depot seem to have pushed price successfully. Walmart, as you say, had serious inventory problems earlier in the year, but their grocery business seems to have really saved them. But Target really has problems, and their earnings report this week was a mess. So we've got on screen a table that you took out of some government data looking at estimated change of sales for different types of retail firms, building materials, general merchandise, and food services. And things seem to be going very well for everyone except general merchandise stores like Target. So can you help us understand why is that the case for, I mean, maybe Target's just terribly run, but why is that the case for general merchandise specifically? And what does this say about the U.S. consumer? Is the U.S. consumer kind of dead in some areas?
No, the U.S. consumer is not dead, which is the strangest part about this earnings season to me is, everybody, kind of read into Target's report and was like, wow, this is horrible. It's bad. Target is its own problem. I mean, they're merchandising horrible. Their executive team, horrible. I mean, I don't know how you survive this. With Walmart putting up huge comp numbers on a relative basis. I mean, they pounded Target. And to me, that was signal number one. That's Target. That's Target's issue. The general merchandise store, we bought a whole bunch of stuff during COVID that we don't really need to buy 17 of, right? You bought it during COVID. You could get Walmart and Target delivered to you. That was a boon for their business. And that's just not being repeated. Same thing with, if you look at Best Buy and electronic stores, not doing great because we all bought TVs during COVID and computers. We needed them at home. I mean, these are just pivots. When you look at the retail, when you look at the numbers for restaurants, when you look at it for grocery, I mean, again, a lot of it is pushing price onto the consumer, but the consumer is taking it, and those are pushing revenues higher. I mean, you look at the company that controls Popeyes and Burger King, absolute blowout same-store numbers. I mean, these are restaurants that are pushing price. They're still having traffic, and they're not getting enough pushback. I mean, Home Depot pushed 8% pricing, well, almost 9% pricing in the quarter. They didn't care about foot traffic. Foot traffic was down mid 4%. They didn't care about the foot traffic. They got to push the price, and they, guess what, blew it out. Lowe's had a decent quarter. These are housing companies,
right?
At least home exposed companies and building exposed companies that had great third quarters that were supposed to be getting smashed, right? Yeah. The housing is not supposed to be the place that you're going to right now, and somehow these companies could push enough price. I mean, if there's something of a tailwind to the consumer where the consumer is kind of learning to take it in certain areas and just saying, no, I don't need another t-shirt, or I don't need to make another trip to Target. I mean, I think it's pretty much a story of where the consumer is spending, not if the consumer is spending. I mean, that retail sales report, it'll get revised, who knows by how much, but the retail sales report, even if it gets knocked down by a few bips, call it 20 basis points, 0.2%, it's not going to be a big deal. It's still a blowout number. I mean, these are not things you want to see if you're the Fed thinking about going from 75 to 50. I mean, kind of two reasons there. One is that pricing a little too much. And if it begins to become embedded, not necessarily in the consumer's mind, but also in the business's mind, I can push price, I can push price, I can push price. That's a two-sided coin where the consumer is willing to take it and businesses are willing to push it. That is the embedding of inflation expectations moving forward. I mean, going back to, I think it was last quarter, Cracker Barrel announced earnings, and they were like, "Yeah, we're seeing some traffic woes, but we're going to push price next year, and here's how much we're going to push it by." I mean, these companies aren't slowing down their price increases, and they're not seeing enough of a pushback from consumers.
Well, and
Yeah.
Cracker Barrel and Walmart are not top-end market companies. They're mid-market companies, right? And so, and if they're able to push price at the mid-market, then it says that your average consumer is kind of taking it. But the volume is down, so fewer people are buying things, but the ones who are buying are paying more. Is that fair to say?
It's fair to say, fewer trips, more expensive.
Okay.
It's fair to say, but there's also something to point out where Macy's, their flagship brand kind of had a meh quarter. Bloomingdale's, their luxury, blew it out. Had a blowout quarter. Yeah. So you're seeing even within general merchandise stores, you're seeing a significant difference between call it luxury, middle, and low.
Okay. So what is it about, say, Target and Macy's? I'll say Target more than Macy's, but is it just the management or is it the mix?
Merchandising.
It's
merchandising and it's the mix of goods, right?
Okay.
And if you don't have the right stuff that you can push price on, you're not going to make it. NGMI.
So will we see some of these general merchandisers move into other sectors, grocery or whatever?
I mean, Target has grocery. Target has grocery, TVs, clothes. I mean, they have everything. I mean, it's a question of, do you have the right thing to sell right now in terms of that? So I don't really think you'll see many big moves, mostly because they already have too much inventory. So their ability to pivot is zero at this point. So it's just, it's going to be a tough holiday season. I think it's going to be a pretty tough holiday season for Target. But I didn't see Walmart taking down numbers for the Christmas season.
Yeah.
I mean, we'll see with Amazon, but cool.
It seems healthy. They just observationally, they seem pretty healthy.
Yeah. And the other thing to mention, just as a side note, is there's a lot of this consternation around FedEx and UPS and their estimated deliveries for Christmas. This is the first year that Amazon has had a very, very large fleet going into the Christmas holiday season where they don't have to send packages through FedEx and UPS only. They have a very, very large in-house fleet of vehicles to do so with. And they built that out massively over the past 18 months. So I would read a lot less into that for the Christmas season, read through to Amazon, et cetera, than people are. That's something I think it's kind of taking the big picture and missing the finer points.
Yeah, I had a question really on that same vein. We're seeing, I'm seeing a lot of the, freight companies that report on freight, like Freight Waves, have been screaming at the top of their lungs that, loadings are falling, people are going out of work, they're firing everybody, nobody's delivering anything, nobody's delivering any goods. Do you think that's sort of cyclical, or because there's still, it seems like there's a mismatch right now with it. There's a lot of goods out there to be delivered, but for some reason, these guys can't get loadings.
I think it's two things. One, everybody double ordered in spring and summer. So I think Freight Waves and a lot of other companies saw, a lot of loadings that they wouldn't have seen otherwise, and you spread those out. And I think that's point number one. Point number two is these retailers are stuffed with inventory. I mean, Target, even Walmart, somewhat elevated. They don't have that big of a problem, but so they have the inventory. I would say it's much more of a timing issue, and you'll probably see Freightways have too many loadings, call it in the spring and summer of next year, because people are playing catch up and trying to get the right merchandise, et cetera, et cetera. So I think it's just more of a COVID whipsaw than anything else.
That makes sense.
Great. Okay, so bottom line, U.S. consumer is still taking it, right? They're still spending. They're still okay, despite what bank deposits and other things tell us. Things are still moving. And is that largely accumulating credit, or how is the U.S. consumer still spending? They're accumulating credit?
I mean, a couple of things. One, they have, their bank deposits are fine, unless, particularly at the middle and upper levels, they're still relatively elevated. Two, you're getting a much higher wage. So you're marginal propensity to consume when you see a significant pay raise, even if prices are higher, is higher, right? So you're going to spend that dollar. So you're getting paid more. You're switching jobs a lot more. You know, your switchers are getting something like almost a double-digit pay increase. You know, these are rather large, you know, shifts. So I would say the consumer feels a lot more comfortable with taking the inflation because they're getting paid a lot more. Unemployment is sub 4%, so they're not afraid of losing their job unless they're at Twitter. And you know, so the consumer's sitting there like, all right, I'm not losing my job. I'm getting pay increases. Why would I stop spending? I mean, I think it's that simple.
Great.
And you know, yeah, they have credit cards, but and credit card balances.
That is a very important point, what you just mentioned, employment. No? Employment makes all the difference. The pain threshold of consumers is always being tested. No? Companies raise prices, volumes are pretty much okay, so they continue to raise prices to maintain their margins, and that works for a period of time. I think that what is happening both in the Eurozone and in the United States is that after a prolonged period of very low inflation, consumers also feel comfortable about the idea that inflation is temporary. So basically everybody, and actually I had this on TV this morning, we were talking about everybody is saying, okay, so prices are rising a lot, but when are they coming down? But I'm still buying. No? The pain threshold starts to appear when employment growth, wage growth starts to stop. And at the same time, prices go up. And obviously the companies that feel comfortable about raising prices start to see their inventories rise. No? So it's always difficult because we never know. And there's a variable there that we're very unsure of, which is credit. No? It's how much credit are we willing to take to continue to consume the same number of goods and services at a higher price. But it is absolutely key what you're saying, which is as long as, even though wage growth in real terms might be negative, but you're getting a pay rise, and you still feel comfortable about your job, you feel comfortable about your wealth to a certain extent, and credit keeps you safe, consumption in the United States is not going to crack. However, where do you see it cracking? And we're seeing it cracking in the Eurozone. In Germany, where you don't get the pay rise, you don't get the benefit of taking expensive credit from numerous different sources or cheap credit from numerous sources. And at the same time, you get elevated inflation. Consumption is actually going down the drain. So that's the way that I see it is that the consumption not collapse, but certainly the consumption crack is very likely to happen more north to south in the Eurozone than in the United States at the rate at which the economy is growing.
Yeah. Nails. Yes.
Yes. Very good. Thanks for that intel on Europe, Daniel. That was really helpful. Okay, let's do very quick. What do you expect for the, say, week or 2 weeks ahead? We have a Thanksgiving holiday here in the US, so things are going to be kind of slow. But Tracy, what are you looking for, especially in energy markets over the next couple of weeks? We've seen energy really come off a little bit this week. So what's happening there?
Yeah, absolutely. And, you know, part of that is the reason, part of the reason of that, besides, you know, all the global factors involved, the recession didn't help. UK came out and said they were already in a recession. That didn't, you know, spark fears. We have pipeline at reduced capacity right now, which means that's going to funnel some more crude into Cushing. WTI contract is actually Cushing. So that's putting a little bit of pressure. You know, I think holidays, you know, obviously I think this next week, we're not really going to see much action as usual. So really looking forward to the following week is, you know, we have the Russian oil embargo by the EU, and we also have the OPEC meeting. And I would suspect that at these lower prices, they might be considering cutting again. So that's definitely those two things I'm looking forward to in that first week in December.
Great, thanks. Daniel, what are you looking for the next week or two?
The next week or two are going to be pretty uneventful, to be fairly honest. We will see very little action from or messages that make a real difference from Fed officials or from the ECB. On the energy front, there's plenty of news, so we'll be paying attention to Tracy's Twitter account. But in Europe, we will get quite a lot of data that is likely to show again this slow grind into recession that we've been talking, and very, very little else. I think that from here to December, most of the news are not going to change where investors are, and that will probably start to reconfigure our views into the end of the trading season, 27th to 28th. So.
Okay, very good. And Sam, what do you see next week or the week after?
I'll just be watching Black Friday sales. How those are coming in. Honestly, yep. I think that'll be a pretty important sign as to how things are developing into the holiday season and begin to set the narrative as we enter December. Again, there's no real interesting Fed talk coming out next week, but we'll begin to have some pretty good data coming from a number of sources on Black Friday, foot traffic, internet traffic, etc. Tuesday and Wednesday.
Very good.
The following week. That's all I care about.
Excellent. Really appreciate that. For those of you guys in the States, have a great Thanksgiving next week. Daniel, thank you so much. Have a fantastic weekend. Always value your time, guys. Thank you so much. Have a great weekend.
Thank you.
Thank you.
Have a great weekend. Bye-bye.